All right, this is part 5. We have been advancing the ideas behind this trendline moving average strategy. First, we started off with a simple pullback on the 10,000 tick chart to the 20 EMA. Then we studied it pulling back to the 50, and then we studied it pulling back further and further until we eventually have to come to the point where this trendline strategy is no longer useful for that particular direction, say bullish, and we hold and we stop trading and we wait for a reversal to take it to the short side. But this is the 5th part. Let's take a look at what we're studying on this 5th part. This is all for the same concept of trendline moving average strategy, trendline break with moving averages, going long, going bullish, and we're just slightly changing the idea of what trend line we're going to use, or what moving average we're going to use when it pulls back. We've been going deeper and deeper on the pullback. So in this one, it's a trend line strategy using the moving averages, multiple time charts, of course. Time charts is 1,000, 2,000, and 10,000 tick charts. Moving averages are 20, 50, and 200 exponential moving averages. And we do use other variables, Fibonacci, support and resistance, and I have incorporated ICT strategies, fair value gaps, order blocks, and these ideas here, liquidity sweeps, and all that. In this presentation, the trend line strategy looks for a price to break a trend line in the direction of the moving averages or in the direction of the trend. On the 10,000 tick chart, that's the one we use. That's our guide. Once price crosses the trend line, consolidates, and pushes past the 200 EMA on the opposite side, it will be time to consider reversing the direction. Okay, so it's only going to be valid as long as price stays above the 200 moving average on the 10,000 tick chart. Once price falls below that and continues down, then it's get out of the position as fast as possible and hold and wait until you have a better understanding of where price is going to go. All right, we're using the futures micro contracts. And again, the rules are follow the 10,000 tick chart moving averages, the 20 and 50 EMA. As long as they stay above the 200 moving average, we have a bullish bias. So whatever direction they're going in is the direction that we use. All right, so with this example today, we're going to be finding a good setup in a grinding market. All right, let's take a look at the next slide here. The red box, these areas of weakness is what we're going to be looking at. All the different trend lines that can happen inside this downtrend, looking for it to bounce back up. And this is just the overall big picture of the 10,000 tick chart on the top and the 1,000 tick chart on the bottom before the trend lines are drawn. Let's take a look at the next slide here. Checklist questions. Did price fall below the 50 EMA? Yes. Did the 20 EMA cross below the 50? No. Then it's okay to find trendline breaks. But we do have the deepest pullbacks where we don't prefer that. But once price goes below the 20 and the 50 exponential moving average, and the 50 and the 20 and the 50 start heading down towards, here's the 20, here's the 50. 200 would be down here. Well, once price goes down so far and the moving averages cross one another, then it's a danger zone. Okay, then price is underneath the 50 and underneath this. Right now in this picture, price is only underneath the 20. Price is only underneath the 20. All right, price can actually go down below the 50 and these moving averages can still be above one another like this. And sometimes it'll curve up like that. But once the moving averages cross each other like this, and price is way down here, as long as they're still above the 200 moving average, we still have a chance to buy. And that's the worst case scenario. That's the deepest of pullbacks that we can take. Then we have to start looking for to not take any more patterns. So see, this is what I'm saying right here. In this right here, you can see the price had fallen below, let's go like this. Okay, right here, this is not the 10,000 tick chart, okay? This is the 1,000 tick chart, and you can see the different trend lines that we've drawn on this, looking for a bounce. And we're going to go over each one of these in this presentation and show you which one finally worked. The last one finally worked really good. But on the 10,000 tick chart, if price had fallen below the 20 and the 50, then we could still look for a trend line break. But once it falls below the 200, like this, then we're no longer looking for a trend line break way down here. This is not the 10,000 tick chart. This is only the 1,000 tick chart. And on the 1,000 tick chart, you will get this violation all the time. As long as it doesn't happen on the 10,000 tick chart, you're okay. All right, so let's take a look at what happened here. On these trend line breaks, on the 1,000 tick chart, we have two losers in the beginning because all it did was go up and come right back down. And the third one was a loss. No, the first one was a break even. You're able to break even on these if you know what you're doing. Second one was a full loss. Third one was a full loss. Finally, we get a breakdown here, and this was a big, gigantic win that made up for all of the losses that we had on the other one. And what we're looking for is it to break the trend line. Really, if it breaks the trend line, you're going to want it to get back up over the moving averages. But we'll take the trend line break before that because we know that on the 10,000 tick chart, price is still bullish. That's why we don't want the 10,000 tick chart to fall below, the moving averages. We don't want them to cross, and we don't want price to really go below them, especially when they cross. If the moving averages cross one another, the price is obviously too far down. But price can go below both moving averages and the moving averages still not cross, is what I'm saying, on the 10,000 tick chart. That's the way it has to be. Okay, so let's go back to this. We were looking at all these trend line breaks here. First one was a break even. Second one was a loss. Third one was a loss. Fourth one was a win that outperformed all the losers. What do we got here? Here's another trend line break where we enter, where it hits the first target, where the stop loss is. I'm trying to think which one. That was trend line 1. It was a break even because we didn't, this is the break even one. This is the first one that was a break even. This is where we entered, and this is where we would have stopped out at break even. It went to first target. When it goes to first target, we take our stop loss from the bottom and move it to break even, to entry, and it came back. It would have come back down. This would have been, that's why this first one was a break even. Okay. Remember this first one right here? It was a break even. The second one was a loss. Third one was a loss. Fourth one was a home run. So this is just showing us the first one, how we would have broke even. You could have taken a 1-to-1 reward on it, really, right? Now the second one, if we didn't catch the first one, we would have been in the second one. If we caught the first one, we wouldn't have been in the second one because these are so close together. So this is the second one. If we had missed the first one, we would have tried this second opportunity here where it breaks this trend line here. This was a full loss. Why? Because it didn't go all the way up to first target. We didn't have a chance to move our stop loss from down here to break even. It went halfway up and immediately reversed. That's why it was a full loss. Okay. Here's the third one, which was a full loss again. It didn't go up to target 1. It came before we had a chance to move our stop from down here to break even where we entered. It didn't go up to target 1, so we had to keep it on break even, and it was a full loss. Okay, that was the third trade. This is the home run. Okay, you could see our stop loss down here at the bottom. Here's our entry. When price went up to 1-to-1, we moved our stop to break even. Our stop came from here and went right to break even. It kept going and going and going and going and going and going until we hit the 4th and 5th target on this, more than making up for the losses on the other ones. Good risk management, holding the winning trades is the key. Getting out of your losing trades quickly and holding your winners as long as possible is part of the strategy. And that's the conclusion. That's the fifth part of our PowerPoint presentation using these strategies. And I hope that that helps explain this strategy we're using on this channel. Peace.